Hi there. Welcome to another Weather Wednesday, where we take a look at weather data and associate it with key factors that drive commodity prices. And so, what I want to talk about this week is the ENSO Index. What is the ENSO Index? It's basically a measure of the phase of the cycle in the El Nino La Nina cycle that many of us are familiar with. Basically, ENSO is a reading off of the equator waters. And it basically is what is used as kind of the barometer of whether we're in an El Nino phase, a La Nina phase, or whether we're sort of in the neutral. Now, this index that I show you is a monthly index. We have it back all the way to 1870, but I'm just going to show you a snapshot of it over the last, call it 12 years. And the idea is that, that cycle happens quite a bit where we see positive ENSO index values. Those are associated generally with a El Nino. And then you can see where we have periods where the ENSO index is negative. That's associated with La Nina. So basically, this index is a measure of either warm waters or cool waters along the Pacific equator area. And so positive values are warmer than normal waters associated with an El Nino, which we had been in. And now we're starting to head into what many meteorologists suggest will be a La Nina. In other words, this ENSO index should be dropping below zero. Right now, you can see as of about 7 months ago in December, it peaked out around 2, the index did. And most recently, the latest reading through July is about 0.1, so about zero. But the expectation is that as we progress, we'll start to get into a La Nina. Now, a La Nina, as many of you may know from following grain markets, is generally that, when we set up with a La Nina in our late fall and winter, that usually spells problems for Argentina and maybe some of southern Brazil. So the question I have for the data is, what do we see when we go from a period of a El Nino reading, call it in late December, to a zero reading in July? So I'm going to look back historically over the years and see which of the years pattern match this kind of, bubble, if you will, a +2 in December and a +1 in July. And what I found was kind of two recent years, recent being in the last 20 some years, that kind of pattern match this ENSO cycle. And the question I have is, when we look at those 2 years, what do we see for price behavior? So I'm going to start with corn. And I'm going to look at the July corn contract. And I pulled out the 2 years that I referenced. They happen to be the 2003-4 marketing year. So we're basically looking at the July 2004 contract going post-harvest in, call it, October 2003 all the way to June 30th of 2004. And then we're also going to look at 2017 July corn. Again, 2016 is kind of the start period and ending in June 30th, 2017. Now, the red line or the orange line is the most recent year, the 2017 year, the blue line, the 2004 line. What you can generally see are a couple of things that I think are important. One is that there tends to be more up after September 1 eventually, depending on the year. You can see that the year from 2004 backed off a little from September 1, fell about 9% by, call it, mid-October, and then it started to take off, and you can see it gained up to 35% in the spring, and then kind of back down after that. Now, the more recent year, which is probably more reflective of what's been going on in South America, you can see we never actually fell from September 1. We were always above the September 1 price with the zero line here, and we stayed kind of in that 5 to 10% range for much of it, and finally kind of peaked out in February, March, somewhere around 12%. Now, that's very consistent with our AI quantum hedging model. Our projections show some modest recoveries starting in kind of late 2024 and into 2025. Not a huge upside, but some recovery as we move forward. And so our QH model is pretty consistent with these results. And the other thing I would say is, if you're thinking about option strategies probably might be a good play here, because there seems to be more upside potential than there is downside risk at this point. For soybeans, very similar, although a few caveats that are worth discussing. One is you kind of see that both of those years, saw a pretty solid recovery out of September 1 prices into a peak sometime in December, and then backing off in late December, early January before at least the blue line kept going. The 2017 line, the orange line, again, peaking sort of in that February, March period. So, again, very, at least according to these charts, not a lot of downside risk here. So again, this might be a good move for an option strategy. And speaking of option strategies, if you're looking for, the white glove treatment as a market advisor, our team at Quantum Hedging has our managed acres program. You can learn about how we use options to kind of take advantage of some of these moves, as well as incorporate our AI models into decision making. So have a great week, everyone. I will talk to you next week.